Hello, greetings. Welcome to Dividend Blasters. This is our 81st video. Topic today, continuing to discuss our journey in selling covered call options. The past week, I collected more than $2,100 in covered call option premiums. So I got to tell you, considering the environment we're in a very volatile environment in the markets. They've been downward adjusting, particularly the last couple of days last week. I feel good that I am pulling in cash weekly because I feel that I am cushioning my financial position with options premium income, and I'm not having to borrow for this. I'm using my shares as collateral to collect more premiums. And I'm really kind of taking advantage of the current market environment. And I can use this money for paying bills or buying the dip, which I may very well do as we move forward. So anyway, I'm going to talk a little bit about just a little bit about the current environment and also what I did the last week. But first, a quick disclaimer: I'm not your advisor. This video is for information, education. It reflects my own personal opinions, research, and experience as an independent investor for more than 30 years. So do your own research, consult an advisor before you make any major financial investment decisions. So, as I was saying, this is a volatile environment. And if you look at the last 5 days, you can look at the major indexes. They do not lie, but we all know this. The Dow Jones Industrial Average down more than 7% in the last 5 days. And most of that came from last Thursday and Friday. The S&P 500 also, even a little bit more, down 13.64%. And most of that was Thursday and Friday. And then the Nasdaq 100 almost 8%, and you can see that real aggressive downward dip the last couple of days. So the point of this is that we live in a volatile market. There's lots of things going on. Uh, Everybody is always on tenterhooks when there's another Fed decision coming up. More recently, we are going through trade adjustments. Our president and the administration is imposing tariffs on several of our trading partners that already imposed tariffs on us, and we just kind of accepted this for years. He wants to go ahead and re-level the playing field. So there's going to be some adjustments. But you know what? Am I worried? No, I am not worried for a couple of reasons. I am not worried because I'm a dividend investor. I also am selling covered call options and I've got cash coming in. But even more broadly said than that, the market's always going to recover. It's about time in the market. That's really what it is. And you've heard this before. Other folks who have been working in the industry, economists, everybody, leaders in business say it's not about timing the market, time in the market. Because more often than not, you're going to come out ahead. And you really have to be in the market because trying to time the market's a fool's errand. You can't win. You cannot beat the market. And for me personally, I am cushioning my position against market volatility through my dividends and also now through selling covered calls. So I am turbocharging my dividend investments with these covered call options premiums, and it's a really nice thing. And I found this wonderful quote from a gentleman at Fidelity's a portfolio manager, and the quote is this: monetizing equity market volatility is an attractive source of structural cash yield generation. You know what? If you got the shares and you you can go ahead and you can make cash by selling covered call options. They're covered, so you just need to set an effective strike price out of the money. We've talked about this. Uh, if you don't want to sell the shares, you want to keep them like I do. That's what you do, and you got that cash coming in, and this can be a nice way to supplement and even exceed your dividend income regularly and routinely. That's what I do. So, what did I do the past week? Well, I did several covered call options. I did, I don't know, between 15 and 20 of them. I'm going to go through them quickly. So let's go. Let's get to it. I sold one covered call option on AbbVie, and I collected more than $85 in net premium. So you can see the premiums collected were 86, and then there was a fee of 66 cents. So that netted to 85.34. That strike price was way up there at 215. I sold the option a little under 210, and you can see where it ended up. It ended below 190, and it's the last 2 days they went down. And looking at this in retrospect, I got to say, hey, listen, I should have set that strike price lower. But you know what? Look where I started out. I thought that was actually a decent strike price, and I used the delta, and that delta was a little under 0.23. I like to strive for somewhere around zero point 0.3 and not to exceed it, because that tells me that there is a less than a 30% chance of the option being assigned and the shares getting called away. So that's what I did. This whole volatility thing that really happened the last few days, um, kind of unpredictable, but it's always good to be ready and play it safe where you can. So next one, Amazon. I sold a covered call option, and I collected $108.34 net. One contract I sold at around 190 with a strike price of 192.50. Which, when I did this, I thought it was cutting it kind of close, but look where it ended up. It ended up down near 171. I mean, all of these really took a bit of a beating. You know what? And if I wasn't getting dividends on all of my other stocks and I wasn't selling covered call options, I'd be sweating. But I am not worried for a couple reasons. I got cash, I got dividends coming in, and I also know that the market's going to recover. It always recovers. Next one, Broadcom, the chip maker, and I do love Broadcom. Uh, and I sold one contract. And as you may know, and if you don't, just a little bit of background, you need to have 100 shares of these to sell a contract, a covered call contract. So I sold one covered call of Broadcom, ticker symbol AVGO. I set that strike at 170. All right. And I got in around 162.66. And I collected $150. Very simple to do. But look what happened to that price performance. It went way, way, way down below, and it closed around 146. And you know what I also use, in addition to the delta, and you can see that delta is around 0.26. I look at this, the simple moving average, the 10-day and the 50-day. Well, we're way below those now. But we didn't know that at the time. But to me, those are a couple of extra nice data points to have, because what you're striving to do here is to select a strike price that is uh, close but below those simple moving averages. With these shorter trades, I'm looking at a 10-day simple moving average. If I'm doing a long trade, if I'm doing like a 1 month duration contract, I'm going to look at the 50-day moving average. So I put them both out there just as a frame of reference. So that was Broadcom. Next one is Chevron. So I sold one options contract for Chevron. I selected a strike price of 170. And I got in around 167.44. And you can see, again, this one went way down and it closed around 160. No, I'm looking at the wrong one. 143. You know what? I am a big fan of Chevron. I think that, and I have several energy companies, some of the smaller ones, and a couple of the big ones, but right now Chevron is my biggest. Um, I got to tell you that, to me, this is a great company, and they have great cash flow. And to me, this is going to be a great buy. I will buy the dip, and I'm going to add to my holdings of Chevron. And I collected $65.34 alone just on this trade. And I may go ahead and increase. Now, I'm not putting up all my holdings. I could put up more of them. I got a few hundred shares of Chevron. I just did 100 shares, and I've been doing Chevron 100 shares pretty routinely the last few weeks. So, and if I put up more, I'm going to get a higher premium. But this is, the way I'm doing this right now. We'll see. All right, next one is Google. Google. Aha, I collected 65.34 on this one as well. I set that strike at 170, and you can see that I got in to this options trade around 157.30, and it was earlier in the last week, earlier last week, and um, you can see where it closed. It closed at around 146. This one went way down, and again, it's the same thing that we're seeing with these others. The market performance, this major correction in the last 2 days went way down. So, and obviously when this happens, the option expires worthless. And I retain my shares, and of course, I keep my premiums. Next one, NVIDIA. Now, NVIDIA, I'm a little more aggressive. I sold 6 options contracts. I sold 6 covered calls. So 600 shares I'm putting up here of NVIDIA. And I set that strike at 110. And I'm showing you 2 lines here, 2 strike lines, because I have these shares across 2 different accounts. I have 500 in one account, 100 in another. And I'm using basically all my NVIDIA shares here. I may want to buy more. Um, and you can see that I got in the 104, 105 range and some change across both accounts. And this was within seconds. So you can see how quick that price changes. And, the delta is in the 0.26, 0.27 range. This closed way down. It closed, down in the $94 range. And, you know, and I collected $681 for 1 week. Okay, net premiums $681 on my NVIDIA shares. Option expires worthless. I retain my shares. I'll do another trade Monday. Next one, another chip maker, the premier primary foundry chip maker in the world. They do all the assembling of chips. Taiwan Semiconductor. I collected $133.34 in net premiums. I set that strike at 170, and I got in the trade around 164.20. And you can see that this thing closed way below around 146.80. So again, major downward spike. It'll be interesting to see what happens next week, Monday and Tuesday. I'm very curious to see if this continues to go down, because to me, this is not a reflection of the companies. These are a number one, prime investments. So I am not worried about these companies performing. This is just the market reacting to some public policy moves. All right, next one. UPS. UPS has actually been getting beat up quite a bit the last several months. And I sold 2 option contracts here. And I set that strike at 112, and I got in around 109.88. And I collected net $109.88 premium. So anyway, it's just coincidental that that's when I got in, and that was the premiums collected. But you can see the delta is around 0.26 for both. Those are fairly safe, and then really safe, because look where we ended up. We ended up around $97.71. So that's the price. And I got my cash. I'm getting the dividends, and this is a great dividend stock, by the way. All right, next one. Next one is Visa. So Visa, I collected $149.34 in premiums. I set that strike at 350, and I cut this one kind of close when I got in. This was trading for around 344 when I got in, and but look where it finished. It finished the week at 313. I think Visa is a wonderful stock. And, Visa is actually not a volatile stock. And it just continues to actually perform beautifully. And it slowly, slowly, slowly goes up. But, with what's going on in the market, everybody's been affected. So am I worried? No, I am not worried. I am actually going to take my premiums and I'm going to buy some more. And I collected $149.34 in the past week. You know what? This stuff all adds up. So if you continue to do this and replicate this, I am going to be generating significant cash flow every month and throughout the year. All right, next one. Okay, this is an ETF. This is my Vanguard S&P 500 ETF VOO, and I sold two covered calls, so 200 shares there. I collected $548.65 in net premiums. And when I got into this trade, I got very close because I believed, for a couple reasons, that this is a very gentle moving ETF. This is the market. So you can look at that delta. It's a little under 0.3. So I'm very comfortable selecting a strike price where that delta is 0.3 or below. Um, now, when I got into the trade, it was around trading for around 506.46. I set it for 515, and you can see that this thing finished well below 466, 465 and some change. So I retained the shares. I collected $548.65 in premiums. I'm going to do another trade next week. Walmart. You know, this is one company that I just love, and I love these stocks. I am just so pleased. And this company just generates so much revenue. It's amazing. There's actually a battle royale now going between them and Amazon. Amazon is starting to catch up close. In the year to date, Amazon actually beat them the last quarter, but year to date, it's still Walmart. Now I collected $51.78 in net premiums with my Walmart trades. I did two covered calls. I got in around $86 and change. I set the strike at 86. So, no, I'm sorry, 89. That's wrong. I set it at 89, and the table's right. The graph is wrong. I do apologize, but anyway, let's press on. So this thing closed well below the strike. It continued to go down. It closed last week around 83. The option expired worthless. I retained my 200 shares, and I keep my premiums at $51.78. So all in all, I would say this was a good week. Nothing was assigned. It's a kind of hard to get an assignment with the market performance, but I like to believe that the strike prices I chose were pretty good. So you can see that the premiums collected around $2,161. And then after the $12.10 fees, it netted out to $2148.90. So not bad at all. 19 trades. So I'm pretty happy with that. And there were a couple of trades that I did the previous week that expired yesterday, worthless. I already counted my premiums in the previous video, but just so you know, Coca-Cola expired worthless. So I keep my 100 shares of Coca-Cola. Of course, I already got the premium there of $28.44 from the previous week. Energy Transfer. This is one of the other energy companies that I own. I put 200 of my shares up for this covered call, and sold two covered call options, and I collected $18.87. This thing expired Friday. You can see the performance the last couple of days. It was getting close earlier in the week. It was getting right near that strike line on April 2nd, which was Wednesday. But Thursday and Friday went way down. So those holdings are retained. Pfizer. This one expired Friday, and this one, there was really no chance of this one being assigned. So I collected 2287 the previous week. It expired worthless on Friday. I got my holdings retained, and we move on. And Verizon. This is 100 shares of Verizon. So one covered call option contract. I collected $15.44. And you can see it did start to get a little bit close on Thursday, and then Friday went way down. and it closed way below that strike line. So this one expired worthless. And for me, these are the ideal outcomes. I'd rather not, have the shares called away. But when they are, I don't sweat it. I will either just go and buy them right back. I'm going to watch the price, especially if it goes down, or I'll sell a cash secured put. I'll buy them at a further discount. Either way, I'm making more of a gain here. All right, and then of course we have this one here, which I bought a while ago. I bought it on March 27th. This one is still active. This one will actually not expire until April 17th. I already collected, um, over $1,000, $1,015, almost 1,016 actually, close, in net premiums. Uh, and I got into this option below 200, it's around 198.67. I set that strike at 205. It was kind of trading sideways, and then around Wednesday, it started to get a little bit closer, but then it went down. And you can see that it's in the 170s right now. So I am watching this closely. Um, and we got about another week and a half to go on this. And this is one of these where you can't do a weekly option. Some of the ETFs you have to do a month. Or maybe 3 weeks. It really kind of also depends on when you get in. So anyway, that's kind of where I am. I'm watching that one. I'm going to report back on that. And if you look at the last 6 weeks, um, I've collected about $14,483 in net premiums after the fee. So the fee is about $100 or so. So that's pretty good. Those premiums mostly are going back and being redeployed across the portfolio. Some of them in the holdings that generated them from those options trades. Some of them in other places. It's just up to me. So my average weekly yield, I'm averaging about $2,500 a week. I could extrapolate that, and monthly that's about $10,000 a month, and annually that could be $120,000. Am I going to do that? I don't know. Maybe, maybe not. It depends on the market. It also depends on how well I do, and how the trades go. So we will see. So, folks, that's it. And before I wrap up, I just wanted to offer you the opportunity to subscribe to Seeking Alpha. You can get uh, a 7-day trial period or a really nice discount, either for the premium membership or if you want to go above and beyond that, Alpha Picks. In addition to being an affiliate partner that allows me to get you the discount, and I got the links here, and I'm going to put them in the comments field as well. I'm also a subscriber, so I leverage the information and the tools afforded to me by Seeking Alpha. It's a great, great tool. And if you want to follow me on social media, I am on X, Instagram, and Facebook. And folks, that's it. That is it. I hope you found this to be informative and enjoyable. If you would kindly give us a like, share the video with a friend, hit that notification bell, and we would love to have you as a subscriber. Until our next day, have a wonderful, wonderful day. Our next video. Have a wonderful day. God bless.